All right, let's talk about something that almost no one is explaining clearly right now. And yet it could quietly change how much money stays in your pocket every single year. If you are 65 or older, or if you and your spouse are both over 65, I want you to slow down for a moment and really listen to this, because what we're about to cover is not noise, it's not political talk, and it's not one of those exaggerated online rumours. This is a real IRS rule already written into law that could protect thousands of dollars of your retirement income from federal taxes. And the reason this matters so much is simple. Most seniors are already doing everything right. You budget carefully. You plan ahead. You try not to touch savings unless you have to. So when the government quietly changes how much of your income they tax without sending you a letter or making a big announcement, missing it can be expensive. Today, we're going to break this down slowly, clearly, and step by step. No confusing tax jargon, no rushing, no assumptions, just the facts and what they actually mean for you. Why this new IRS change matters right now. Here's the first thing you need to understand. This is not a small adjustment like the ones you see every year, where numbers move slightly because of inflation. This is a new additional deduction created specifically for seniors. And unlike many tax changes that only help people with high incomes or complicated investments, this one was clearly designed for retirees living on fixed or modest incomes. That's why it's catching so many people off guard. It didn't come with loud headlines. It wasn't widely explained on TV. And many tax preparers haven't even started talking about it yet. But it's real and it's powerful. The number you should remember. Let me give you one number right now. $6,000. If you're single and 65 or older, that's the potential extra deduction you may qualify for. Now here's the part that really makes people stop and pay attention. If you're married and both you and your spouse are 65 or older, that number doubles. $12,000. That's not a credit. That's not a loan. That's not something you pay back later. That's income the IRS may not tax at all, money that stays in your account. What exactly is this new deduction? The official name doesn't matter as much as how it works, but for clarity, it's often referred to as a senior bonus deduction. And the word bonus is important here, because this deduction does not replace anything you already get. It stacks. That means you still get your standard deduction. You still get the extra age-based deduction for being over 65. And now, on top of that, this new senior deduction may be added. Think of it like layers. Each layer shields more of your income from federal taxes. And that stacking effect is what makes this such a big deal. Why stacking matters so much. Let's pause here for a second. Most people assume deductions are either or. Either you get this or you get that. But this rule works in addition to what already exists. That's rare, and it's exactly why this change can dramatically lower taxable income, especially for seniors who rely on Social Security, small pensions, IRA withdrawals, part-time income. All of that income is counted when taxes are calculated, but deductions reduce how much of that income is actually taxed. Let's walk through a simple example, no math stress. I want to keep this easy. Imagine a single retiree, age 67. They have Social Security, a small IRA withdrawal, maybe a little interest income. Before this new rule, only certain deductions applied. Now, because of this additional senior deduction, thousands more dollars may be protected. And that can be the difference between owing taxes or owing nothing at all. For many seniors, the tax bill doesn't disappear because income goes up. It appears because deductions don't keep up. This rule helps fix that, at least temporarily. Yes, temporarily, and that matters. Now, here's something extremely important. This deduction is not permanent. I want to be very clear about that. It only applies to 4 tax years, 2025, 2026, 2027, 2028. After that, unless Congress extends it, it's gone, which means there is a limited window to benefit, and that window affects how you might time IRA withdrawals, decide when to take income, plan part-time work, manage retirement savings. This isn't just about taxes, it's about planning smarter over the next 4 years, who this was really designed to help. This rule wasn't written for millionaires, it was written for middle-income retirees, seniors on fixed incomes, people feeling squeezed by rising costs. That's why income limits matter, and we'll cover those in detail in part 2. But here's the key idea for now. Even if your income is not extremely low, you may still qualify for some or all of this deduction, and even a partial deduction is still real money saved. What this deduction does, and what it does not do. Let's clear up confusion early. This deduction does not magically make Social Security tax-free. Anyone telling you that is wrong. The Social Security tax rules themselves haven't changed. However, and this is important, by lowering your overall taxable income, this deduction can reduce how much of your Social Security ends up being taxed. Indirect effect, real impact. That's why it's so powerful, but also why it's misunderstood. Why many seniors may miss this. Here's the uncomfortable truth. The IRS does not automatically apply this deduction unless it's properly claimed. If you file the wrong form, miss a checkbox, or rely on outdated advice, you could leave money on the table. And once a tax year passes, fixing mistakes can be stressful and slow. That's why awareness matters now, not later. Why scammers will target this. Anytime there's a new benefit for seniors, scammers follow. They will call email, send letters, offer special help for a fee. Let me say this clearly. You do not need to pay anyone to unlock this deduction. The IRS does not charge fees. The forms are free. Most tax software will include it automatically if you know to look for it. We'll cover exactly how to claim it in part 2. Before we move on, take a moment and ask yourself this. Over the next 4 years, could protecting thousands of dollars from taxes help you? Breathe easier, stretch savings further, handle unexpected expenses, because that's what this rule is really about. Not politics, not hype, not fear, just giving seniors a little more room in a very tight financial world. It's time to talk about the details that really determine how much you personally can benefit, because this is the part where a lot of people get confused. They hear about the $6,000 or $12,000 number, they get excited, and then they assume it applies the same way to everyone. It doesn't. So in this section, we're going to slow things down and talk about income limits, phase-outs, how the math actually works, and most importantly, how to avoid mistakes that could cost you money. Let's talk about income limits. This part matters a lot. This deduction was created to help low and middle-income seniors the most. Because of that, the IRS placed income thresholds on it. That doesn't mean you're automatically disqualified if you earn more. It means the deduction may be reduced gradually as income rises. This process is called a phase-out. Here are the key numbers you need to know. For single filers, 65 or older, full deduction available up to $75,000 of income. Deduction starts shrinking above $75,000. Deduction disappears completely at $175,000 for married couples filing jointly, both 65 or older. Full deduction available up to $150,000. Phase out begins above $150,000, deduction fully gone at $250,000. If your income is below those lower numbers, you may qualify for the full amount. If your income is between those ranges, you may still qualify for part of it, and partial is still better than zero. How the phase out actually works, simple explanation. Here's where people panic because they expect complicated formulas. It's actually straightforward. For every $1,000 your income goes above the threshold, the deduction is reduced by $60. That's it. So let's say you're single, you're 68. Your income is $85,000. That's $10,000 over the $75,000 threshold. $10,000 divided by $1,000, or 10 to 10x, $60, $600. So your $6,000 deduction would be reduced by $600. You'd still get $5,400. And that $5,400 still lowers your taxable income. Why partial deductions still matter? Some people hear phase out and stop listening. That's a mistake, because every dollar of deduction reduces taxable income, lowers your tax bill, keeps money in your pocket. Especially if you're on the edge of a tax bracket, deductions can make a bigger difference than expected. For retirees, this can affect whether Social Security becomes taxable, how much Medicare premiums cost, whether you owe anything at all. This isn't theory. This is how the system actually works. Does this apply if you're still working part-time? Yes, and this is important. Many seniors work part-time freelance, do seasonal or contract work. As long as you are 65 or older, your income stays within the limits, you can still qualify. This deduction does not require you to be fully retired. That's a big deal in today's economy. Standard deduction versus itemizing. Do you have to choose? Normally, the tax code forces you to choose, either itemize or take the standard deduction. This rule is different. This senior deduction works either way. That means if you take the standard deduction, you can still claim it. If you itemize, you can still claim it. That flexibility is rare and extremely valuable. It means you don't have to rearrange your entire tax strategy just to qualify. Now let's talk about how to actually claim it. This is where many people go wrong. This deduction is not automatic. You have to file correctly. Here's the simplified process. Step 1. Use the correct tax form. When filing your taxes, use Form 1040 SR. It's designed specifically for seniors. Larger print, clearer layout, easier instructions. Step 2. Confirm your age. There is a checkbox confirming that you are 65 or older. That box matters more than people realize. Step 3. Complete the additional schedule. There will be a new schedule used to calculate this deduction. Most reputable tax software will guide you through it automatically if you enter your information correctly. If you use a tax preparer, make sure they are aware of this deduction. Do not assume. Ask directly. Clearing up the biggest rumor, let's address this clearly. This deduction does not eliminate taxes on Social Security benefits by itself. Anyone saying that is wrong. What it does is lower your overall taxable income. That can reduce how much of Social Security is taxed, sometimes reduce it to zero, but only indirectly. This distinction matters because misunderstanding it can lead to bad planning decisions. Real-world impact. What does this mean in dollars? Let's put this into real terms. If you qualify for a $6,000 deduction and you're in the 22% tax bracket, that's about $1,120 saved. That's not abstract. That's prescription costs, utility bills, Medicare premiums, emergency expenses. For married couples qualifying for $12,000, the savings can be even higher. For seniors on fixed incomes, this is meaningful relief. Why timing matters over the next 4 years. Remember, this deduction expires after 2028 unless extended. That means the next 4 years matter more than usual. This could influence when you take IRA withdrawals, whether you delay or accelerate income, how you plan part-time work. This is not about gaming the system. It's about using the rules as they exist. A serious warning about scams. Anytime seniors become eligible for new benefits, scammers appear. They will pretend to be IRS agents offer special filing services. Ask for payment or personal information. You do not need to pay anyone to claim this deduction. IRS forms are free. Reputable tax software handles it. Legitimate professionals do not pressure you. If someone rushes you, walk away. This rule wasn't created to confuse you. It was created to help seniors keep more of what they've earned. But it only helps if you know it exists. Understand the rules. File correctly. Missing it doesn't hurt the IRS. It hurts you. So don't ignore it. Don't assume someone else will handle it. And don't let fear or confusion stop you from claiming what you're entitled to. One last question for you. This deduction gives you a 4-year window, a window that could protect thousands of dollars. So the real question isn't whether this rule matters, it's this. How are you going to use it to make your retirement more secure while it's still available?